A joint committee hearing on the future of digital assets measuring the regulatory gaps occurred on May 10th. It was 3 hours and 41 minutes long. And so what I've done in this video is brought it to under 60 minutes for anyone who wants to understand and know the key points, but may wish to save as much time as possible. Enjoy.
This hearing is entitled, "The Future of Digital Assets, Measuring the Regulatory Gaps in the Digital Asset Markets."
Frankly, if we're going to get the kind of progress that we need to get, we're going to have to do it working together. And I think our committees have been working together for weeks and months now, trying to make sure that, that we bring certainty and sensible compliance to the digital asset space. We know that digital assets and the blockchain technology hold real promise. From facilitating payments to increasing data privacy and managing supply chain logistics. These networks represent a new way for individuals, a new freedom for them to make better business decisions. However, current federal laws and regulations provide few rules of the road for those who want to engage with those emerging technologies. I think all of us know the current uncertainty does not serve us well. It doesn't serve the marketplace well. The CFTC and SEC continue to debate whether certain digital assets are securities or commodities. Those conflicting enforcement decisions create further confusion in the industry and the market, and I thought our hearing folks today in their pre-filed testimony did a good job of explaining how problematic that has been. One of the pieces of testimony, I think, noted that most of the G20 countries are ahead of us. Because in the absence of U.S. leadership, they're creating frameworks and establishing themselves as hubs for the development of the digital asset ecosystem.
What we decide to do in this Congress this year will shape whether or not the digital asset ecosystem has the opportunity to thrive here in the United States. But right now, there's not a workable framework in place for digital asset issuers and intermediaries to be regulated effectively by the SEC or the CFTC. I've heard a few members in this room say that the status quo of existing laws is enough, that crypto firms are just willfully avoiding compliance with the law, and that Republicans somehow are off embarking on a partisan pursuit of sweeping digital asset legislation. But the reason I know that this can't be a partisan exercise is because my Democratic colleagues have been telling me they support common sense legislation for months.
The digital assets industry continues to claim that it lacks regulatory clarity and that its products and technology don't fit into existing regulatory schemes. I believe that industry advocates make these claims because they know that the current prevailing business models for crypto are not compatible with orderly markets or investor protections law. The problem is not regulatory ambiguity, it is mass non-compliance with existing laws. We're now exploring whether we need a new regulatory structure to cover digital assets, which would likely undermine well-established laws and regulation. I worry that erecting a new law could be viewed as a light touch and encourage other industries to morph their products so that they can meet the definition of digital assets, and thereby avoid long-standing, long-established investor protection and orderly markets requirements. I encourage my colleagues to not get lost in a debate over whether individual tokens are securities or commodities. Instead, we should take a step back and examine the intermediaries that facilitate these tokens, such as the exchanges, lenders, and wallet holders. Digital assets companies want to serve multiple functions, but there are clear rules for companies that function as exchanges, broker-dealers, or clearing and settlement agencies. Some digital assets companies try to flout the rules by being all at once. Rather than comply with existing rules, various cryptocurrency firms have engaged in a legal battle against the SEC. The SEC has brought 130 enforcement actions and prevailed in every single one. They often argue that they lack guidance or their products aren't what they clearly are. In closing, I welcome the conversation that explores the potential of these products, but given that the majority of the industry has failed, I find it difficult to understand the benefits without proper regulatory compliance.
The purpose here is to make law, for us to give assurance to the marketplace and to consumers, to close regulatory gaps, to make sure that you have like-kind regulation of new things in our society and the potential they hold. We need to get this right, both for a couple of reasons. One is to harness innovation and enable consumer protection, and the other is to ensure that the CFTC and the Securities and Exchange Commission will work together to ensure that consumers are protected, unlike what is currently happening. Look forward to the panel's testimony, and I want to thank the members for joining in this little committee room.
My name is Andrew Durgee, and I am Executive Vice President for Republic and co-founder of its blockchain technology business, Republic Crypto. For those who are not familiar with the Jobs Act and Crowdfund Act, they created two new regulatory securities exemptions known as Reg CF and Reg A+. These allowed for a novel framework for retail, meaning non-accredited investors, to be able to invest in companies prior to an IPO. This was a groundbreaking change from the Securities Act of 1933, and it finally gave regular citizens the ability to participate in the financial upside of early-stage companies. Regulators point to these exemptions as functional for Web3 companies to comply, but they struggle from both logistical disclosure and SEC approval standpoint. The disclosure requirements simply do not work within an industry trying to decentralize itself. On a certain, for example, once a certain number of investors or token holders are reached, the issuer is then required to register under Section 12G of the Exchange Act, inherently limiting access and inclusion from other eager participants. It's nearly impossible for a company to push towards decentralization without triggering this requirement. The second issue is the SEC approval process. Republic has attempted to register a Reg A+ security token with the SEC for the last 3 years, and after 12 turns of that document and countless legal bills, we've still been unable to get approval. In fact, the current administration has not qualified a single digital asset offering. Thus, the current system is not working as intended. Much of what this committee has discussed, and will certainly discuss today, is around crypto assets and their speculative form. But it's important to remember that what we are really discussing is a technological innovation, and one of its first use cases that has operated at scale just happens to be digital currencies. We are in the early stages of this technology, and I really want to provide some examples of that. It generally takes about 25 to 30 years for human beings to adopt a new data transfer technology. Radio was invented in 1890, but wasn't commercially available until the 1920s. TV was developed in the 1920s, but wasn't in homes until the 1950s. Email was invented in 1969, but most of you most likely didn't have an email address until 1997. There is one that I really want to focus on, and that's TCP/IP, which is the internet, for those that don't know. It was developed as a DARPA project in 1970, but it wasn't really commercially accepted until 1995 when it was rolled out with Windows 95. There's another important date, which is 1983. 1983 is when TCP/IP was accepted as the standard protocol for internet development, 13 years after it was created. Well, here we are, 13 years after Bitcoin was created, and we're just now starting to talk about standardization. This is not a coincidence. Adoption at this stage is not a technology problem, it's a human conditioning issue. Every 13-year-old in the United States has only existed in a world where Bitcoin has existed. 3 years from now, every 16-year-old will have only existed in a world where Bitcoin has existed. 16 years old is an important date because it's generally when someone becomes interested in becoming a developer. They are the adoption layer. We here in this room, we're the infrastructure layer. It's our responsibility to create an environment where every 13-year-old American has a framework upon which they can build the next world on. Thank you, and I look forward to your questions.
Congress should expand the CFTC's role to include regulatory authority over the digital commodity spot markets. Doing so would introduce key features that are found in the futures markets, and they've worked well to protect customers for years. In addition to segregation of customer funds, I mean things like financial resource reporting requirements for intermediaries, exchanges conducting real-time surveillance over trading activity, regular examination for compliance with CFTC rules, and of course, enforcement for non-compliance with these rules. From 2017 to 2019, I had the privilege of serving as a division director at the CFTC. And put simply, I have great confidence in the CFTC's ability to carry out its mission to protect customers and promote the integrity, resilience, and vibrancy of markets. There's an important leadership role for Congress. Here, Congress should make clear that the CFTC is the primary regulator for digital commodities, and the SEC for securities. I believe that approach will provide these markets and market participants with a framework that respects existing laws conventions, and market structures. Congress should build on its precedent in a manner that best protects investors and at the same time attracts and retains the innovation that has made U.S. capital markets the deepest, most transparent, and competitive in the world.
My name is Marco Santori. I'm Chief Legal Officer at Kraken Digital Asset Exchange. Kraken was founded over 11 years ago. Since then, we have steadily grown into one of the world's leading global digital asset businesses. We are proud of our roots as a Bitcoin exchange, but we're equally driven by the societal and economic value that is developing well beyond financial services. Blockchains are transforming the way that we consume goods and services, secure data, and even deal in property rights. Our primary business is operating an exchange to match buyers and sellers in digital assets. Today, we serve over 10 million customers around the world through a secure and transparent centralized platform. Congress, led by these subcommittees, can fill these gaps to improve markets, empower consumers, and ensure the United States participates in the world's next wave of technological innovation. As you've heard from other witnesses today, there is clear precedent for Congress here. Following the 2008 financial crisis, Congress passed Dodd-Frank, which set up lines of demarcation and joint supervision of swaps markets for both the CFTC and the SEC. Today's collaboration across committee members and staff and across party lines demonstrates both the willingness and the ability for Congress to get this right.
I am Daniel Schönberger, the Chief Legal Officer at the Web3 Foundation, and I've worked at the intersection of emerging technologies, law, ethics, and public policy for more than 20 years. The Web3 Foundation was formed with the goal of establishing Web3, a new and better internet infrastructure. It wasn't about building a currency like Bitcoin or a smart contract platform like Ethereum. It was about giving siloed blockchains the ability to communicate with each other, and to realize this vision, the Polkadot network was built. And let me be very clear, if a token is used for fundraising purposes, it should be subject to all applicable laws and regulations. However, that same token may serve a functional purpose devoid of speculative investment in the future. We fully support putting into place a legally binding process of token reclassification. And we applaud the subcommittees for undertaking the hard work and deliberation necessary to develop a legislative framework. We would ask you do so with the understanding an approach that recognizes new technologies. To simply apply existing regulation would be inadequate to truly address this emerging technology.
You know, since 2014, when I became chairman of the CFTC, I've talked about the gap in crypto regulation, and you've heard a lot about it today. Obviously, we don't have a federal regulator of the spot market in tokens that are not securities. And we have this classification debate, which makes that gap worse. So the question is, how do we fix it? And there are now lots of calls for maybe tinkering with securities laws definitions, coming up with a new category, coupling that with giving jurisdiction to the CFTC. The part that concerns me is that rewriting of the securities laws and creating that new definition, because I think it is likely to generate its own questions of interpretation that may lead to lots of litigation and confusion. I think it may also create unintended loopholes. And frankly, we don't have the information today to know how to classify tokens, to apply the Howey test. So I think there's another approach, and which is that we would pass a law that requires that any trading platform or lending platform that uses or trades Bitcoin or Ethereum has to comply with a set of principles for everything it does, for all the tokens on the platform, for all of its activity. And those principles would be the ones we're all familiar with: protecting customer assets, preventing fraud and manipulation, requiring risk management, requiring reporting, requiring trade transparency, preventing conflicts of interest, and so forth. Congress would direct the SEC and the CFTC to develop joint rules implementing those standards, or create an SRO that would develop those rules and implement and enforce them. So I think there's several advantages to this. One is it's simple. The law would give us jurisdiction over all of those platforms that are important, because no platform can exist without trading Bitcoin or Ethereum, without having to rewrite the securities laws.
My name is Michael Blaugren, and I'm the Chief Operating Officer of the New York Stock Exchange. National securities exchanges, such as the NYSE, serve a fundamental role in the capital markets ecosystem by providing a forum for companies to raise money, as well as a venue for investors to buy and sell the securities of public companies at transparent prices in a fair and orderly manner. So, how best to protect public investors who seek to engage in the digital assets market? The lesson to be drawn from the more established markets is clear. The segregation of key functions within the financial markets ecosystem, brokerage, exchange, clearing, and custody, mitigates inherent conflicts of interest, promotes transparency, and facilitates competition among service providers. This, in turn, benefits investors and results in a more fair, efficient, and safe environment.
We appreciate our panel's testimony. We'll now turn to our member questions. I recognize the chairman of the Subcommittee on Commodity Markets, Digital Assets, and Rural Development, Mr. Johnson, for 5 minutes.
I know this town loves kicking the can down the path, but there are times where it's just clear, even to Congress, that action is appropriate and needed. Mr. Durgee, I was so grateful for you to point out that a 13-year-old has only grown up in the Bitcoin era. We've learned a lot during that time, and in fact, every single witness that we have today, and every single witness we've had before our subcommittee on digital assets, have all said that there is a lack of clarity within existing law that is holding back innovation in the marketplace. It is holding back America's ability to be competitive in this development space, and it is not properly protecting consumers in the broader marketplace. And so we get to a point where we know that action is appropriate. I think the contours of what that looks like are beginning to come into focus, thank goodness. But I want to hone in on one of these central questions, and I'll come to you, Mr. Culkin. We know that the Howey test, one of the legs of the Howey test, is about whether or not a centralized group of decision makers have a substantial impact on the value of that thing. If they do, it's highly likely to be a security. In Mr. Schoenberger's testimony, he talked through the multi-year process that Polkadot went to be more decentralized. Why is that an important characteristic of when something can go from being a security to becoming a commodity?
So, Chairman Johnson, thank you for the question. The Howey test really looks at the issue or sale of a security. So you're thinking about it at the moment that the product is put out for investors. I would distinguish that, as some of my panelists described, I would distinguish that from trading down the road after it's been put out, where you don't necessarily have the expectation of profits based on the efforts of others, and it becomes more fungible, or I might even say more commoditized. And then the trading in that market, in the secondary market, it looks a lot more like a commodity as defined by Congress.
So, Mr. Massad, you were the chair of the CFTC at a time when the agency was implementing Dodd-Frank, which provided the Commission with additional regulatory authority over the swap market. Were there similar concerns at that time for the CFTC's ability to oversee those swap markets?
Absolutely. It's not possible for the CFTC, or frankly any agency, to suddenly take on a whole new area of jurisdiction without additional resources. In the case of the swap market, we did the best we could, but we were cutting a lot of other activities that we should have been, I think, spending more on. Oversight of a lot of the existing market, the existing infrastructure. It's as if you all decided, you know what, let's have the Capitol Police not just do the Capitol, but all the airports around Washington, but let's not give them any more resources. It just doesn't work.
Some of the elements of digital assets that users want to know about, and indeed the people in this room are likely to ask about if they were to ever use digital assets, include the number of nodes operating on the network, how many developers are actually developing on this network, whether these developers are associated or whether they or whether they are operating independently, where those nodes operate from. These are highly technical and digital asset specific characteristics that frankly I could probably list for well in excess of my time or your time, Chairman Hill.
I think it'd be useful if you just expanded on that in writing and just talk about those specific disclosure gaps. I think that would be helpful to me.
I think Commissioner Peirce's approach is thoughtful. It is well tailored to the risks and the rewards. I think that Congress has tremendous discretion in this regard, but Commissioner Peirce's proposal would be light years ahead of what we have today in terms of protecting consumers and allowing us as a global business to continue to plan to invest here in the United States.
So the U.S. financial system is indeed, as a number of you have said, is the envy of the world and a source of strength, not only economically, but in international relations, in the geopolitical sphere. But it is built on trust, right? It's built on trust at its very core. And every time a crypto firm explodes, whether that's FTX or Terra or Voyager Digital or Genesis or Silvergate, which is a crypto bank, and as a result of those explosions, investors get locked out, and now we have millions and millions of investors who are trying to get their money back, unsuccessfully so far. We lose trust. We lose trust in that system. And we also know full well that criminal enterprises, it's a favorite tool of some of these hacking episodes that we see, criminal entities, foreign and domestic, actually capitalizing on the anonymity there and using that to further their criminal enterprise. So you've got all that going on, and now we have an effort by some to import all of that instability, all of that risk, all of that volatility into the previously stable financial system. And as my colleagues, Ms. Caraveo has pointed out, there's a suggestion that, well, we'll move this over to the CFTC, which has about 600 employees. Take it away from the SEC that has about 4,500 employees and has a hard time keeping up. So, Mr. Massad, what are some of the, you've talked about it a little bit in your opening statement, but what are some of the measures that would be necessary if we were going to try to share jurisdiction here or shift those responsibilities over to the CFTC? And just as a heads up, Mr. Blaugrund, I want to ask you, the same question with respect to the SEC and what that would involve and what gaps you see in that exercise. But Mr. Massad, go ahead.
Thank you. Thank you, Congressman. Well, obviously, resources. You cannot expect, frankly, either agency to really tackle this market in a much more substantial way, in the way that we need, given the lack of investor protection. Without significant resources, it would be very, very significant in the case of the CFTC. I often said to Chair Benham when he was suggesting they get spot market authority, I said, be careful what you wish for. But secondly, I think it still goes to this question of what exactly would they be getting jurisdiction over? And that's where, again, I would rather see a system where we force the two agencies to work together, to work through an SRO, and that way the industry could basically have to pay for it.
Can I ask you on that, on a self-regulatory organization, are there examples out there that you think would offer instruction?
Sure. I mean, first of all, by self-regulatory organization, I mean something that is closely supervised by the agencies. It doesn't simply go off on its own, like FINRA, like the NFA. We do have a precedent for jointly recognizing those SROs. And so what I'm suggesting is sort of going the next step where we say, all right, we're going to have a joint one that is mandated to do this common task, if you will, and develop rules that would then have to be approved by both agencies. But again, I think it's a good interim step forward. It would allow us to bring this sector within regulation, which I think is better than pushing it out.
I want to. Our committees have a historic opportunity to work together to create a comprehensive digital assets market framework that will provide a pathway for developers and users to engage with digital assets in a safe, compliant, and quite frankly, productive manner. So my first question I have is Mr. Culkin. Mr. Culkin, Mr. Masad suggests that the CFTC and SEC should establish a joint self-regulatory organization, SRO, to regulate pursuant to core principles established by Congress. Do you think a CFTC-SEC joint SRO construct is an efficient, effective, and a practical solution?
So thank you for the question, Mr. Chairman. I agree with a lot of the diagnosis that Mr. Massad has offered. I worry that creating a new SRO from scratch would take time. I don't know. I think about this in terms of incremental progress, and I don't know that we need to recreate the wheel here. And so I noted in my opening statement that more than 70% of digital commodities currently being traded are commodities. And so by expanding the CFTC's authority beyond just enforcement authority, which is reactionary, to regulatory authority and requiring those exchanges, those intermediaries, to be registered, regulated, examined, and then subject to enforcement, that's probably a quicker path to providing the investor protections that are currently lacking in these markets.
And now, ladies and gentlemen, our cryptocurrency markets are rife with fraud, misuse, and volatility that seem to pose all risk and no reward for our everyday investors. So here's my real point. This supposed benefits of digital assets that we have all heard about have yet to be seen in real life. It doesn't work as a currency. And I ask you, do everyday Americans pay for goods and services using cryptocurrency? The answer is absolutely not. And importantly, it does not advance economic inclusion, and as so many platforms claim they do. Ladies and gentlemen, I have spent 20 years as a member of the United States Congress fighting for true financial inclusion. And that means ensuring that consumers are protected from fraud, are protected from scams, and are not subject to hefty fees for their transactions. Also, it means improving the overall financial health of all consumers, especially low-income consumers who are unfortunately regularly left out of our financial system. So let me ask you, how does pushing these same consumers into opaque, risky, volatile markets advance these goals?
Would you please?
There's no way they do. So,
Mr.
Chairman
Scott,
Masad.
Mr.
Yes.
Scott, I would like to ask you to direct that question to somebody to respond in writing because your time's expired.
All right. Please, Mr. Masad, respond in writing.
Estimates that were referenced in the testimony indicate that anywhere between 50% and 95% of Bitcoin transactions are fakes, that is, wash trades and similar frauds on the market. So for the first question, does anyone on the panel believe that it is possible to conduct a well-regulated futures or derivatives market when the underlying asset is subject to this level of market manipulation? Let the record show that no one believed it was possible.
Sir, you have two people with their lights on. I think.
Is that right? Okay,
Well,
yes.
well, Congressman,
So describe how you can have a well-regulated derivatives market when the underlying asset is subject to massive market manipulation.
Well, I think that question supports why the CFTC, which is limited right now to simply monitor
the spot
for fraud.
market, right? Yeah,
That's right. And
I agree completely. That's the point. You agree with the point that we've got to do a better job. We have to eliminate manipulation of the spot market to have a well-regulated derivatives.
Yes.
Okay. So everyone concurs with that. Great. Now, if we wish to prevent wash trades, insider trading, front running, money laundering, ransomware, and everything else, is there any alternative to having both sides of every crypto transaction associated with a traceable digital identity, and have that digital identity issued by a government with which we have extradition treaties and a common concept of financial fraud? Is there any alternative to that? All right, let the record show that no one came forth with an alternative.
Sir, are you asking whether there is an alternative to a digital identity
How do you
issued by a
prevent wash
government?
trades without associating both participants in any crypto transaction with a trusted, traceable digital identity?
I do believe there are alternatives to that. I believe the alternatives are numerous.
Do you describe one example of something that can prevent wash trades that does not have traceability of digital identity to both participants?
Kraken, for example, monitors our exchange for abuse and market
on your
manipulation.
exchange, but you accept Bitcoin, which gets traded anonymously on the dark web without that. So you're basically a portal to that. You can't, you're not preventing.
I wouldn't say that at all. I think we play an important role as gatekeepers in this industry.
But there are wash trades happening with self-custody that you cannot control, for example.
I would be surprised if wash trades happened in any meaningful sense. Trades cost. They are expensive to do on-chain, and particularly in mass. Wash trading on-chain is regularly detected by forensics platforms. There are vendors.
For some crypto assets, there are crypto assets where the identity is much more difficult to trace, and I believe this is not possible, and the market will no doubt move to those if it is driven by the desire to do anonymous and fraudulent trading. So I think that really, to my mind, the place that we have to go, well, actually, Mr. Culkin, you mentioned on page 9 of your testimony that various industry participants have suggested that various KYC solutions, including even at the wallet level. And so this strikes me as where we're going to have to end up here. Now, if you just look at the automobile industry and how essential it has been to the correct and the development of the automobile industry to have license plates mandatory on every car and have the license plate issued by a registered driver. It would be completely unacceptable to have unlicensed cars with unlicensed drivers cruising through your neighborhood or coming across your international borders. And so for the same reason, I believe we will have to issue a trusted digital identity associated with every, at the wallet level. Every crypto wallet, you'll have to say, I want a wallet, go to a government that we trust, and have that wallet, the license plate issued for that wallet. So that's personally, could you describe some of the proposals, concrete proposals for wallet level identity?
So Congressman, I'll defer to others. I think someone else on the panel made the point about KYCing wallets, but I would, to build on Mr. Santori's point, note that if the CFTC had regulatory authority over the spot market, it would be able to impose on registrants through core principles in the same way that it does for futures and swaps markets, that the exchanges conduct surveillance, that they KYC participants as part of their onboarding, that they submit to the rules and jurisdiction of the exchange, and those exchanges essentially act as an SRO in addition to the CFTC and NFA. There are a number of digital commodities in addition to just Bitcoin and Ethereum. And I think, to Mr. Durgee's point earlier, that trend will continue. And so creating an artificial restriction to only include those digital commodities, I suspect we would be back here speaking with you again in the future.
Again, Mr. Culkin, I've heard some of my Democratic colleagues, particularly on the Financial Services Committee, claim that because Gary Gensler has declared that nearly all digital assets are securities, that we should just treat them all as such. Do you think this is the right approach, to do nothing and let Mr. Gensler just have full control of the space?
So Congressman, I don't, but I don't think that that's the best approach, because nearly 70% of digital commodities traded today have already been deemed commodities by the CFTC as a body, as opposed to any chairman, commissioner, or staff. And so I think we need to be thoughtful about which products are commodities and should be treated as commodities, just like oil or soybeans or interest rates.
I personally would liken Chair Gensler's approach to my son Sam's approach. He's 2 when it comes to toys. He wants to hold all the toys, but he doesn't want anyone else to be able to play with the toys at the same time. And so I thank you for your answer.
I think that what we have today is abundant confusion and complexity. We have two of our financial regulators here in the United States alleging contradictory positions over the same asset. They have alleged that the same asset, one under oath, sworn in a complaint, is both a security and a commodity, but it doesn't fit into the narrow classifications of assets that can be both, the future. What we have today is the untenable position. What we have today is the unending complexity and litigation that is leaving consumers unprotected and leaving us as a global organization unable to plan and unable to invest here in the United States.
Additionally, up until recently, unaccredited investors could really only participate in post-IPO offerings. Most of the larger gains take place pre-IPO. So when we look at access and inclusion, in particular in districts like yourself, where those individuals don't have the ability to even participate. And so due to U.S. accreditation laws, it creates an even greater wealth disparity between those two people. So when the crypto markets became activated, particularly in the U.S., and you started to see U.S. retail investors participating, it was almost their first glimpse at participating in what would be considered an early stage startup that they could never have touched otherwise. Now, if we had clear regulatory frameworks and consumer protections where they had the ability to participate within those markets and there was some level of oversight, then they would be sitting in a much better position than they are now and still able to participate in something that's early that otherwise they never would have been able to touch.
Because I think it's time for Congress to get to work on digital asset rules because the current regulation by enforcement practice is not working. Last month, the Financial Services Committee, we asked the SEC Commissioner, Chairman Gensler, for his view on the future of digital assets regulations. And candidly, we didn't learn a lot. We didn't hear a path forward for digital asset regulation. Maybe one of the only things we learned was that Chairman Gensler's never traded a digital asset himself. We don't know what Chairman Gensler's plans are. There's not clear rules in front of us. And regulation by enforcement doesn't work. And the come in and register black box the register by black box is serving to chill the digital assets innovation. I don't think we can afford as a country to cede regulation to other countries. I'm concerned that it's going to move innovation outside the United States, move it overseas, costing Americans jobs, and putting U.S. retail investors ultimately at a disadvantage. And I think this hearing demonstrates that Congress is ready to do the job. Let me dive in and ask a question, if I can, of you, Mr. Schoenberger. In particular, when we think about the global construct, right? So if we fail to do this here in the United States and we see innovation move abroad, I want to look at what other countries, what other regions are doing. In particular, how do regulators in Europe view blockchain technology? And in particular, how does this attitude differ from that of U.S. regulators?
Thank you, Congressman, for the question. So I can speak for the Web3 Foundation that took a very deliberate decision at the time to be headquartered in Switzerland. Switzerland provided very early on for a very clear regulatory framework, distinguishing between payment tokens, security tokens, and utility tokens. And also the Swiss regulator, FINMA, issued a no-action letter to the Web3 Foundation back already in 2019.
So would it, only cognizant of my time, would it be fair to say that they took a much more forward-thinking approach in Switzerland and in Europe?
I would say so. I mean, this framework that they provided certainly provided the legal certainty to be headquartered there and have legal clarity around the classification instantly.
Thank you very much. Only cognizant of my time. If I can, Mr. Dergi, if I can shift over to you. We look at the European Union recently approved its market in crypto assets regulations. What lessons can we take away from the EU's experiences as we craft our own market structured laws here in the United States?
Yes, thank you for the question. As we look at the rollout of MiCA, which won't take place actually until 2024, it really is the first large-scale jurisdictional regulatory framework that we've seen from a major market. It's very focused on retail investors, in particular protecting them in the earlier stages of these projects and the project development, but I would say it would be a misstep to only look there. If we look at other jurisdictions out of Dubai, like VARA, we look at MAS out of Singapore, we look at what South Korea is doing, particularly around security tokens and gaming, you start to get a much more holistic view of how the world is approaching the asset class as the United States starts to wait in the wings.
And is those countries have more stability, more clarity, not driving forward through a regulatory approach, but putting forward rules and regulations of the road, do you see more investment and innovation occurring in those jurisdictions?
Extensively so, and the real example is, I think I'm the only one here that actually runs early stage venture funds. We have multiple out of Republic that we run, and in the last 3 years there's been a huge shift to offshore investments. I'd say we're doing over 3x investments now offshore as we worked in the U.S.
I want to start with you, Mr. Durgee, and I want to make sure I didn't misrepresent. If I understand your testimony, is it your view that that cryptocurrencies will help close the wealth inequality gap?
Indeed it is.
Okay. Do you know if you had invested in the S&P index over the last 5 years from 2017 to 2022, you know what the return is you would have earned?
It would not have been terrible.
Yeah, about almost 61%. There's been 12 cryptocurrencies that have existed during that same 5-year period. Do you know what the median return is if I'd invested in that basket of currencies over the same period?
I assume I know the basket you're talking about, and it would be less than that.
It's a lot less. In fact, I would have lost 46% of my money. It's a negative yield. Now, that's the median cryptocurrency, and we could talk about where the other ones are, but according to a recent report from the Bank for International Settlements, 73 to 81% of all of the Bitcoin traders during that period lost money. Do you want to revisit your statement about this being a great way to close the wealth inequality gap?
I think when we look at the wealth inequality gap, we come back to the aspect of accredited versus unaccredited access.
Well, that's a different question. There is the historical data is that this is not actually a way to grow wealth. I am really concerned if we are telling people who do not have the sophistication that this thing where they would have lost 46% of their money over the last 5 years is something other than, I don't know, a way to transfer wealth.
Yeah, I think when we go back and we look at that, and we are all here to talk about consumer protections, right? That is the goal of this conversation.
I ask the point because there is a myth about wealth inequality, and I am happy to debate facts. I'm not happy to debate lies.
And so my first question is for you, Mr. Santori. Your platform is a cryptocurrency exchange. How many crypto assets are currently on your platform?
We support roughly 200 assets globally.
Thank you. And of about those 200 assets, to your knowledge, how many of them are registered with the CFTC or the SEC as securities? Or sorry, with CFTC as commodities or the SEC as securities?
To my knowledge, none of them are.
And so why are none of them registered?
I can speculate on the basis of the projects that work on those securities. My belief is that there is no workable registration regime for those projects. Any registration regime laid out in front of them would require the intermediation of things like a transfer agent that would add nothing to consumer protection and would make the working of those digital asset blockchains untenable.
And in your view, does current law allow for y'all to list unregistered securities on the exchange?
Sorry, the question is, does current law allow for us to list unregistered securities on the exchange? I don't think so.
And so if some of these indeed are securities or indeed are commodities, you wouldn't be allowed to list them if they were unregistered?
You know, I have to tell you, you're getting into interpretations of the law of existing law as opposed to testimony that I can give on facts. I'd say that Kraken takes great strides in not listing securities, and we do not list securities. We have robust processes in place to vet the assets that we do support. We review every asset for, of course, its business use case and its functional use case. We review assets for cybersecurity vulnerabilities. And of course, we have a process in place to evaluate these assets as to whether they could potentially fall into either the world of regulated securities or regulated commodity derivatives.
Thank you. I want to sort of ask a similar question now to Mr. Blaugrund. So can the New York Stock Exchange have unregistered securities on its platform?
We do not.
And so what would happen if it did?
We would be subject to enforcement action, I presume, by the SEC.
Right. So part of what I'm trying to understand here as far as the current state of play is that if an exchange wants to be in compliance with the law, it would have to delist any unregistered securities or commodities. And our current laws, as I understand them from several judicial opinions and decisions that I've looked over, are that crypto assets are either securities or commodities, many of them being determined to be securities. Some of them that we decided today or talked about today, folks agree are commodities, but very few, and in some cases, none of them are registered with the appropriate agency. And so you don't have to be a crypto skeptic or a crypto enthusiast, I think, to come to the conclusion that I'm feeling now, which is some level of concern that even under existing rules, there are real concerns about, do we have folks that should be registered, where we should have protections for investors not registering. And so it is hard to think about the path forward if right now I could be having this concern. Mr. Mossad, I'd love to hear what you think about that.
I think you're absolutely right, Congressman.
There is no realistic path to registration under the existing regime. This is why we're here today to say that Congress ought to act to clarify that path, to give regulators the tools that they need, to foster this ecosystem, to create fair and efficient markets. This is not 2015. This is not 2012 when I first got into this industry. This is not a question of education. The regulators are just as smart, they are just as educated, they are just as up to the moment as the rest of the ecosystem lawyers are. This is a question of tools.
And if you're scared of what's happening in Europe with MiCA, you're going to be terrified when you see the UK regulations come out next, which are going to have substantially more weight and be far more robust. So as we start to look at all the different jurisdictions, whether that's UK or the European Union as far as MiCA, and I had mentioned VARA and Singapore with MAS, Tokyo, et cetera, collectively they're looking at what each one of them is rolling out and figuring out how they're going to be able to work together ultimately to move this industry forward. This might be the first time that we see an emerging technology that ends up finding its way outside of the United States predominantly, in a technology that is still very nascent. As I mentioned, it's only been around now for 13 years, but growing and accelerating at a pace that we really haven't seen before. So I caution everyone here that if we don't move forward and we don't do something, and if MiCA is something that you're worried about, the next book to drop is going to be pretty severe.
If I may add, I think there's a lot of reasons why we have the strongest capital markets in the world and the strongest financial system. Regulation is part of that, but there are a lot of other factors that contribute to it. So I think it's important not to exaggerate the risk here. We clearly do want to put in place a regulatory framework, but I'm not that worried yet about the U.S. losing its leadership ability in a lot of these areas. On the regulatory framework, there's going to be interpretive issues under MiCA as well. Frankly, when you look at MiCA, it applies to crypto assets and it excludes anything that's a financial instrument. Their definition of a financial instrument includes sort of what we define as a security. So they're going to have some interpretive questions there too. So I think we need to move forward with a sensible regulatory framework, but let's not get too worried about losing our edge yet.
Okay. My concern, following up on that, if you would, is that when we look at the weekend collapse of an SVB, look at Republic, this isn't the bank run of old where someone's standing outside around the corner. These are people that are picking up their phones and pulling out $100 billion in a day, in 2 days. So I do think that there's a certain heightened sense of urgency. I'm sorry, Mr. Durgi.
Yeah, no, I was just going to comment, we're talking about the U.S. as a financial superpower. I don't think that's going to change. What we really need to be talking about is from the innovation perspective, the technology components that are going to be leaving the U.S. and developing other technologies outside of potential financial frameworks that the U.S. will not be the ones that own. That is the area that we are certainly the most concerned about. It's when in the opening testimony I discussed that we're going to talk about the speculative nature of the industry, and that's all well and good, but it's the technological innovation component is the area that we really can't forget.
We talk a lot about diversity and inclusion and how this will be a part of this new era of technology that will make millionaires and billionaires. And I'd like to ask you a few questions about diversity and inclusion. Does it include both males and females, diversity and inclusion? If you think so, raise a hand so that I don't have to ask each one of you. If you think it includes males and females. All right, let the record reflect that all hands were raised. That would be 2, 4, 6 hands up. Do you define yourself as a female? If so, kindly extend a hand into the air. Let the record reflect that none of the witnesses would be defined as a female. Do you know any females who would be capable, competent, and qualified to sit on this panel? One hand's up already, there. They all know females who would be capable, competent, and qualified to sit on this panel. Would they bring something to this debate that would be not only of interest, but that would be beneficial to what we're trying to accomplish? Hands up, hands up. All agree. Now, does diversity and inclusion include people of color? Raise your hand if you think so. Let the record reflect that they all think so. And do you know any people of color who would be capable, competent, and qualified to sit on this panel? Hands up, please. A nodding of head won't do. All hands have been raised. Let the record reflect such. I'm asking these questions because, unfortunately, we tend to see diversity and inclusion at the end of a process. I think it starts right here today with you.
We've got a whole panel here, none of whom have said the basic question is, should we allow cryptocurrencies to go forward in the United States? The purpose of our capital markets for working American families is to finance factories and businesses where they can work at blue and white collar jobs and create products that help them in their daily lives. The purpose of our capital markets is to harness the animal spirits, the willingness to invest, and to fund housing and factories and jobs. What this does is it diverts that to something that is a system of a new hidden money system. It says so right in the name. Cryptocurrency literally means hidden money. And to create a tool that has its announced purpose by its most prominent supporters to defeat our sanctions laws, to defeat our tax laws. And it's not that all of you who are in this industry are unwilling to abide by our sanctions laws and our tax laws. It's simply that you think you can make billions of dollars by building a valuable tool for those who do want to cheat on our taxes and do want to evade our sanctions laws and our money laundering laws. We're told, we're gonna fear of missing out. Other countries could get ahead of us. Peru is ahead of us in cocaine cultivation. China is ahead of us in organ harvesting, and the Cayman Islands is ahead of us in innovative tax haven fraud. I do not see the need to catch up. We speak as if this whole idea of creating tools that will turn the income tax into just a tax on wage earners and make it voluntary for the very rich as something new, because you guys are using the internet, because this industry uses the internet. It's nothing new. We had tax evasion tools last century, and we blocked them. The most valuable tool was the multi-billion-dollar bearer bond. One piece of paper earns interest, totally untraceable, and we prohibited people from issuing them. We, of course, have a $100 bill. It's worth $10 from what it was 100 years ago. The $100 bill, the bearer bond are no longer good tools for tax evasion. We need a new one, and you can make billions of dollars if you can create it. All the money and power in this town is on the side of the crypto billionaire bros. There's no lobbyist in this town. There's no executive. Nobody's making $1 million to advocate for tax enforcement. Nobody is being paid to make sure that we enforce our sanctions laws and our money laundering laws, at least not to be lobbyists and not to make millions. And I think it was Mr. Kasten who reminded us of Sam Bankman-Fried. He still haunts these halls. His purpose was give a patina of regulation to this industry by defeating the SEC's efforts. I don't want to say that I'm against blockchain. It's an accounting system. I'm against multi-million-dollar bearer bonds. I'm not against paper, and I'm not against ink. Mr. Massad, if many of these crypto tokens are securities, many of those sold on exchanges are securities. If in any other field of our capital markets, if you had an unregistered exchange where you could buy and sell unregistered securities, wouldn't that be a violation of just about every securities law we've got?
Yes, sir. That would be a problem.
So why is the SEC that would immediately shut down a stock exchange where you had unregistered stock being publicly sold and which an unregistered, they seem unwilling to enforce the law in this area, whereas certainly if it was stocks and bonds, they'd enforce it immediately. Can you explain why they're not enforcing it?
Well, I think the SEC has brought a number of enforcement cases. I think it's important to remember.
But they haven't shut down the businesses that are represented here, and if these businesses were doing unregistered equity securities, they'd shut them down.
I can't comment on...
It just shows the power of the billionaire bros, and I yield back.
What are the takeaways today? I think to recap on today, a couple things are clear. The current Securities Exchange Commission approach to disclosures don't work for digital assets. It doesn't conform with the nature and properties of digital assets. The CFTC needs additional authority over non-security digital assets. The Securities Exchange Commission needs to modify its rules for broker-dealers and securities exchanges. Those things have to happen because the CFTC and the SEC alone can't do this. Congress must act. And it's imperative that we do act. And this committee will act. I want to thank Chairman Hill for his leadership and the bipartisan cooperation we've had from many on these subcommittees and these committees of jurisdiction.
I want to thank my colleagues for their participation today on both sides of the aisle in both committees. Thank the Ways and Means Committee for allowing us to slum here in their beautiful facility without
Mr. Chairman,
objection.
will you yield for...
I will yield to my friend from California.
I'll just point out, if we want clarity, let's just make it clear, and the industry should lobby for this, that the SEC has full jurisdiction. If the CFTC wants to have full jurisdiction, that's fine. I can't think of an industry more in need of double regulation rather than zero.
I thank the gentleman. Reclaiming my time, without objection, all members will have 5 legislative days within which to submit additional written questions to the witnesses to the chair, which will be forwarded to the witnesses for their response. I'd like to ask each of you to please respond as promptly as you are able. This hearing is adjourned.